My only guess is they're afraid to get short in China, expecting delivery in either LBMA or Comex and not being delivered on. And that goes to here we are in March. Registered inventory, I think, is down to close to 70 million ounces. The Shanghai ounces held have just collapsed over the last 4 to 5 months. The inventories are collapsing. Is it this month? We'll find out by the end of the month. Today's what, the 11th or 12th? Yeah, the 12th. We still got to have more than half the month to go. The way Comex is set up,
those that have deep resources of cash, it is devaluing. It's not a long-term asset, but for an emergency period, it will be very useful to hold. You might want to have a greater degree of that as we are going into this, because this could be the setup for the extreme scenario, cold turkey, which would be debt debasement. You get a lot of deflation. There's a shortage of capacity to go further.
The global precious metals market is showing signs of extreme structural stress, with major exchanges facing critical physical shortages. Investors are becoming increasingly wary of holding short positions in China, fearing a catastrophic failure to deliver physical metal on either the LBMA or Comex. With registered inventories plummeting and Shanghai stockpiles rapidly declining, the market is bracing for an imminent, unprecedented supply shock. Billholter and Francis Hunt, two highly respected financial analysts renowned for their deep insights into macroeconomic trends and global debt, break down the severity of this developing crisis. They explain that as physical silver inventories drain to historically low levels across global exchanges, the financial system is perfectly set up for an extreme debt debasement scenario. During these highly volatile, deflationary emergency periods, holding cash, despite its inevitable long-term devaluation, can serve as a crucial short-term asset to help navigate sudden liquidity crises and severe market shocks. Their combined expertise provides invaluable guidance to investors navigating the complex dynamics of commodity shortages and economic instability. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
my question on silver is, why is there still a $12 arbitrage between China and New York and London? That doesn't make any sense. My only thought to that is that, arbitrageurs, they feast on a 1% spread, and they can work with 0.25% spread or 0.5% spread. They'll knock it down to zero, and they make money, and they're happy to do it. Why are they not doing it? My only guess is they're afraid to get short in China, expecting delivery in either LBMA or Comex and not being delivered on. And that goes to here we are in March. The registered inventory, I think, is down to close to 70 million ounces. The Shanghai ounces held have just collapsed over the last 4 to 5 months. The inventories are collapsing. Is it this month? We'll find out by the end of the month. Today's what, the 11th or 12th? Yeah, the 12th. We still got to have more than half the month to go. And the way Comex is set up, there could be 1 day left in trading, and somebody step up with $1 billion, $2 billion, $5 billion, whatever, and say, I want delivery, and bust the market. Now, I don't think that's likely to happen, because would you really want to be would you want the wrath of doing that if you're an individual? And if you're a country, those trades would probably be canceled, and it would be viewed as a declaration of war. If you've got entities that are selling gold, or if you've got paper sellers that are selling gold, the world's central banks, the world's treasuries, the official money, they want gold because they understand ultimately there's going to be a dollar problem, and the world's reserve currency is the dollar. My late partner, Jim Sinclair, used to talk about, the gold being the anti-dollar. And that's the world has taken that to heart. The world is unloading gold because they understand that at some point in time, they're going to have a problem with their portfolio, with their balances, because if it's, way heavy in dollars or, completely fiat, they risk being blown up. And the world understands that. If you and I understand this, Danny, don't you think the smartest people in China, the smartest people in Russia, just name country after country, those people understand that gold is the bedrock of finance. It doesn't look that way because they've tried to demonetize it for 50 years. But the bottom line is fiat currencies originally were a derivative off of gold. And people have completely forgotten that. I mean, it's been a brainwashing for 50 years. The prices of gold and silver right now are telling you, yeah, we're in the end game. I mean, just in the last 2 years, the dollar has lost 50% of its value versus gold. The world's reserve currency is now worth half of what it was 2 years ago in relation to gold. I mean, what does that tell you?
On the silver, it's in and around the 80s, 85, 86. So we are in range, and this smacks to me of a little bit of a basing period over here. It might turn out a nice watermelon smile and the recovery comes, but it's going to wait on gold. Gold will lead. What we did see is because of the crisis, I feel to a degree, it stole a little bit of gold's headlines and that there's a tiny bit of substitution. The biggest buyers of gold are central banks and nation states, and then, the really big sovereign wealth hedge funds and super wealthy. And what we've seen there is nation states might now be asking, do we have enough oil as well? So they were first worrying about dollar debasement, debt debasement, all of that's happening in terms of where we are in the fiat structures. Now, a slightly more urgent problem, maybe not as important, but certainly more urgent. You still need to drive to the gas station to do your shopping, has jumped ahead, and they're looking at energy-based reserves and wondering how future-proof they are. And as a result, that's diverted some of that money that would have been still chasing into metals and putting us into this form of range-based holding position. So overall, I think not excessively exciting for the right here and right now. I would not be saying to you silver's about to turn and smash another $10 to the upside right now or make all-time highs. But I can see a continuation patterns inside this range that we've defined that was around about, I think, the 60s, 70 maybe, and the 120. You're going to build range, you're going to build structure, and then the next major move, I think, would be to the upside. How do we be wrong on that? If we go extreme hardcore and the war gets really vicious and it spreads into other things and banks are being bombed and oil depots are being bombed and we end up with an absolute shortage globally and a ridiculous price, your 250, 300 level, we will get chronic deflation in everything else. So we'll have a massive inflation number on the oil spike. That will cause, it'll suck the oxygen out of the lungs of all other areas. That will cause an AI bubble bust, by the way, and the tech bubble and a lot of other things that are deemed assets that will be very damaging on interest rates, bonds. It will be, and we do see longer run interest rates going higher. That's how you debase the debt. And that takes me back to Nixon, excessive indebtedness, OPEC and the petrol dollar, and then Volcker with the rising of rates and that whole stagflationary era. And then only at peak rates does gold top. And we are very early in that story. This might be the Iran story might be the beginning of the OPEC story, which is, these bad Arabs have all, got together and forming a cartel and making us pay more narrative. And that's why we have inflation. They needed the inflation to debase the debt. We need today the inflation to debase the debt. And your current inflation number, 2.4, 2.5, is an absolute travesty of propaganda as far as I'm concerned. I would refer people to shadow stats for the Ronald Reagan measure, where it stands, John Williams and all of that, and he's been consistent. It is a moving target in terms of the adjustments they keep doing. I see if that happens, then we could make a new low and break the range first. Longer term, the monetary metals are winners because the same solutions come out once we're in a key depression, always the same solutions. And that will also be taken as the opportunity to upload the digital. That's going to be the difference about this boom-bust cycle, is they will create such a problem that I think many people will be thrown out of house and home that are reliant on consumer finance and banking lending where any form of variable rates applies. And there's signs that there's a lot already going wrong in private credit markets and other markets as well. So those are the two roads. How severe are they going to do this? If they want to reset everything and they feel ready now, we go real severe, then everything that can be sold will be sold just to make rental checks, whether it's a business, whether it's a bank, whether it's a consumer. And that gets very ugly. And that could see metals go down first.
The global precious metals market is navigating severe macroeconomic pressures and rapid physical inventory drains across major exchanges. Central banks are aggressively accumulating gold to protect against a collapse of fiat currencies and debt debasement. Meanwhile, surging energy costs are temporarily diverting crucial investment capital. If international conflict intensifies and disrupts energy supplies, higher oil prices could contribute to increased inflation and potential deflation in other assets. This environment may impact technology stocks and influence long-term interest rates. As financial pressures grow, especially for leveraged consumers and private credit markets, liquidations and adjustments may follow. During such deflationary shifts, some selling of assets could occur. Precious metals may face initial declines before possibly rebounding, with tangible commodities viewed by some as a useful asset during periods of uncertainty. Let's get back to the interview.
Gold and silver should have been bid up, but it was basically, if you want to look at it in retrospect, the situation was under control. I mean, the first Gulf War, Iraq got pummeled, and gold and silver got hit. The dollar was bid, bonds were bid, and eventually the stock market was bid. The way I look at this is, this first 10 or 12 days or whatever, it is spectacular, but it's only 10 or 12 days. And the question is, where are we going to be in a month? Where are we going to be in 2 or 3 months? What I see is that we're spending an awful lot of ordnance. I mean, we've shot all kinds of ordnance. How much is left? And yes, defense companies are saying that they're going to quadruple their production, but how much has been shot versus that quadrupled production? We don't know. Going a step further, I don't know if people might want to read what Ron Paul has said about ultimately this is dollar negative. Oh, let me go back for just one step on that. Another thing is we've also shown weapons that we have that were not previously known that we had. Our enemies have gotten to see, what we got, basically. And then talking about what Ron Paul has written, and I agree with it. I think it is very dollar negative. We're certainly spending a lot of money to do this, and we look like the big bully, in my opinion. But we'll see what happens if it does turn out that this is dollar negative, which I agree. I believe it is dollar negative. That also means that it's treasury negative. And if it's treasury negative, now you're talking about credit, and credit is what the United States is addicted to. I mean, the system cannot run without more credit. Think about this: if we're running $1.5 trillion or $2 trillion per year deficit, first off, where does that money come from? If there's not buyers, it's going to be printed. It's going to come directly from the Federal Reserve. So it's certainly not good from a fiscal standpoint. I worry about the longer term aspect of it as opposed to what we're seeing on TV now. Since the start of the war, gold is off maybe $100. Silver's down $4, $5, $6, something like that. So there's not been any big movement in that area. There has obviously been big movement in oil, and that's going to act as a tax which will retard growth. Just understand that the system is on a knife's edge. When I say the system, I'm talking about the financial system. The financial system's on a knife's edge because everything is rehypothecated, everything is borrowed. And the problem with that is if something doesn't go correctly, the risk here is that it starts to spread. It starts to spread to other credit. And we already know that, and we'll talk about this in a minute, we already know that private credit is cracking on its own. It has nothing to do with the war. It's already cracked. We know that commercial real estate, and thus the loans to commercial real estate, has already cracked. So, my worries, obviously you got to think about, am I going to wake up and is the world smoke tomorrow? Somebody lit off a nuke and there was an exchange. obviously that's a potential worry or potential problem. I think uh, from a more probable standpoint is that it infects or spreads throughout the financial system. And the reason I say this is because like I said, everything is so levered that things have to go almost perfect to keep the system together because you can't have loose threads being pulled on in the credit market because you could have credit in one area that blows up, another and another and another. So it's like a domino. If you follow Blue Owl, the BlackRock, Blackstone, there's either three or four uh, funds that have been gated. When I say gated, that means that investors who are already in there, they want their money out, they can't get it. I mean, they've been gated to 5% or 10% of what people are asking for. That on its own can create a bank run. I mean, if you knew nothing was going on and you heard investor XYZ wanted his money out but couldn't get it out, that will spur people to say, hey, wait a minute, if he can't get his money out, I want my money out. That's the way bank runs start.
What you're getting at the moment is we had this sort of extreme extension moves, then we've had corrections. Then you've had a grind period, and you've had a secondary correction. And the interesting part of this is there's quite a similarity. This was a much bigger reset of the leverage, I would argue. But here's a strong upside. There's the main correction. You've had a grind channel up, and then you've got a secondary correction. So there's some similarities. That's a channel in there. There's some technical analysts that I think incorrectly are calling this a bear flag, and I highlight that you've gone through the 78.6 retrace of the absolute high. So where that's 100%, that's 0%. You've retraced too high for that to be a typical bear flag. So bear flags technically look like that and like that. What they don't look like is like this, all the way back up. Of much greater duration. That's not going to qualify as a traditional bear flag for me. But you are in some form of range. There's a little bit of a risk that you've got a little rising wedge there. You could come back. You're in the 4,400 to 5,600 range. And there's some beautiful symmetry to that, Elijah. And I'll show you a little bit of this because it's fascinating, and I enjoy the magic of charts, as you know. So if we do that 5.6 down to the 4.4, you'll note that the midpoint is bang on 5,000. I've done it in black here. That's 5,000 right there. 600 above 5,000, 5,600, 4,400, 600 below. So you've done a perfect pivot around this, for which the 50% is 5,000. Then more recently on the lower time frame, for now, you're showing a little bit of 5,000 support. So if we go back down onto a lower time frame, I've dropped from the daily, and you'll see it now. You'll see that when we tested just through the 5,000, that got bought up. You tested just through the 5,000, that got bought up. So interesting natural defense at a key level. We also had a squeeze here that we traded very nicely, and it delivered that target. And then you got the gap up on the wall that delivered our target, and then you got the secondary slam down that I've referred to. The volatility is reducing and the volume is reducing. So that's telling me that's good, because as you go lower vol and you go lower volume, you calm, and that often is the precursor to a new setup for continuation. We typically expect continuation. So going on an even lower time frame, bring it up to the 30 minutes, for example, just what's going on here, I can already start to see that there's some buying up on a wick there, there's some buying up on a wick there, and you could have a falling wedge type structure. You can come a little lower. We normally expect 3 such moves, 1, 2, and then you can get a third, but then I could see this break short and medium term. If you're an intraday trader, you might have some interest in that going up. Long run, nothing's changed on our bull hypothesis for gold.
The fiscal impacts of ongoing military operations may have significant long-term consequences for the United States dollar and broader credit markets. To address these fiscal demands, the Federal Reserve might need to increase liquidity, which could affect the value of fiat currency. The leveraged financial system is showing signs of strain as some private credit funds limit investor withdrawals, raising concerns about broader risks. Amid this instability, precious metals continue to show long-term strength. Technical analysis suggests that gold is consolidating within a 4,400 to 5,600 range, finding key support around the 5,000 midpoint. As market volatility contracts, this may point to a potential for future gains. Share your thoughts in comment section below. If you found this market analysis valuable, please support the channel by liking this video and subscribing for more exclusive precious metals content. Don't forget to hit the notification bell to stay updated. Thanks for watching.